Hello, my name is Michael Ogg, and I'm joined today by Carlo Queddeng, who's been looking after fund management research at Providence for about 17 years. Today we're going to find out what Carlo does, how he does it, and why it's so important for our investment process. Welcome, Carlo.
Thank you, Mike.
Now, Carlo, 17 years doing the role, 17 years at Providence, is a long time. Can you tell me, what does the day-to-day role entail? What do you do every day?
Well, the role is quite varied. So we take views from the investment committee and we're trying to find where is the most attractive returns on a risk-adjusted basis. So we're trying to find international equities, Aussie equities, credit, property. Where do we think is an attractive place to invest our clients' money for the medium term? And from there, we try to find products which are suitable for our clients to invest in.
And when you say that, what sort of products are you looking at? Is there an example of a product that you've looked at recently you can share with us?
Yeah, so within international equities, there's a few times where it pays to review different funds. Mid caps is an area which we are highly active looking at the moment. Mid caps are trading at around 14 times forward PE, quite attractive versus large cap. Japanese equities is another area that we're looking at. Trading discount to fair value has been for a long period of time, and there's different dynamics within the Japanese economy, which makes us attracted to buying those funds.
And Carlo, what drives us? Is this there's so many different investments, there's so many different funds, opportunities. What's your first filter to look at a certain area?
Yeah, the investment committee is really the first guiding point for us. So we meet monthly, we review risks. Where do we think the next 12 months is going for the economy and where we see is attractive? And from there, then we start saying, okay, well, within this part of the Aussie economy or this part of international equities, we want this specific theme or flavor. And we would review a lot of different fund managers, Lonsec, Bloomberg, Morningstar, they're probably some of our first filters. But then it's about managing risk. So if we can understand what the investment philosophy is and understand the downside protection that they have, and we're able to understand the product, that goes a long way for us to be able to invest in these funds.
So can we drill down into what you're looking for in a particular fund?
Sure, okay. So let's say international equities is a good example at the moment. We'd like to see that there's track record with the fund. So has the manager been investing over the past what period of time? Have they invested during down market cycles? What's their drawdown capture been like? Are they correlated to the other funds that we're invested in? Because we don't want all of our funds to be correlated equally, all going up at the same time and going down at the same time. We want them to be relatively uncorrelated or less correlated to each other. The risk drawdown, the downside capture is very important for us. So most of the funds that we deal with, most of the accounts that we deal with, they're for high net worth accounts, high net worth clients, families. We want to protect their capital. So we don't want to lose more on the downside. We want to protect the downside and get a reasonable return going forward. So there's a number of things, the investor protections, making sure that there's liquidity for clients if we can exit, in where we see if there's growing risk, then we can exit. Can we exit at that point? Is there onerous fees? There's a number of things that we look at. Risk management, do we understand the people? There's a lot of things.
Yeah. So Carlo, just thinking that, what would be your sort of red flag to sell a fund then? I mean, there's obviously all those things you go through to buy a fund, but once you're invested, why would you sell a fund?
There's a number of reasons why you sell a fund. One of them is if they've changed their investment philosophy, that is an immediate formal review of the fund. So let's add as an example, if a fund increases their cash weighting materially over a period of time and it strays away from their original investment thesis, then that warrants an immediate review, and we would review the fund and ask to state why they're changing the investment philosophy. And if so, then we could redeem the fund and invest somewhere else. Another, if there's a lot of turnover within the fund manager themselves, let's say the head portfolio manager resigns, we would review the fund and see if we need to exit at that point, or continue to stay with the fund. For example, if there's a process underneath. Liquidity is also another factor. If there's a lot of redemptions going and we are one of the large holders, we would seek to exit the fund also if there's other large redemptions going on at the same time. Position sizes, we're quite familiar with the fund managers that we're invested in. So depending on how they manage risk, if we think a position size is getting too large, we might seek to exit the fund at that point if it becomes too concentrated for our liking.
And Carlo, what about performance? Because like funds can't always outperform. So if a fund underperforms for a period, what does that mean for you and what does that mean for the process?
Yeah, look, I think short-term performance I'm not too concerned about. Like, I understand, you're not going to get all the calls right all the time. So 3-month underperformance or 1 month underperformance, maybe even 1 year underperformance, I'm not too concerned about. The medium term I am concerned about. So 3 to 5 years underperformance, we would seek to review the fund and see why they've underperformed. Now, it could be just because of the themes that they're invested in. And if our initial investment thesis is still the same, then that's okay. But if the investment thesis has changed, then we can review again and exit the fund or stay with the fund, depending on what the investment view is.
And Carlo, just move on to active versus passive. Like, there's a lot of discussion out there in the broader community, go active, go passive, what have you. What's your stance on active versus passive investments?
Look, I think you can be both, actually. You can actually be both. There is a view that high fees in active management is not attractive, and I don't necessarily agree with that because there's times to be active. So when the market is highly volatile and there's large dispersion within the market, I would rather an active manager then and pay for the fee because they can buy assets at a deep discount. They can, really get that alpha at that point in time. Whereas some areas of the market, you don't mind paying a passive fee for. So during the COVID period, we purchased STW Index Tracker and the Vanguard International Equity Index Tracker. Just because.
So before we go, what is the STW Index Tracker? What's it tracking?
So that's tracking the ASX 200 large cap index. And we just wanted instant exposure to the market at that point in time. The market had fallen quite aggressively. It reached our buy levels and we wanted instant exposure very quick to take advantage of that market dislocation. Now, did we have time to review 3 different funds, 5 different funds within Aussie equities and international equities? Well, that COVID bounce back was over within 2 months. So no, we didn't have that time. We didn't have that luxury. Now, at that point, we were able to deploy funds quite quickly and we were able to generate alpha over that period. Another example of active, actually, during that COVID period, we purchased a retail property when it was trading at over 50% discount to NTA. Now, we could only do that through an active manager that was tracking retail property at that point. So there's a case for both. You don't need to be one or the other. Physical gold is an example when you might use an index tracker. We use active physical gold, which is an index ETF, and that doesn't have the operational risk of a Aussie mining company, as an example. That's an index play, getting exposure to physical gold price without the company risk.
So what I'm hearing is it's not black and white.
It's not black and white.
It's not just this one or this one.
Yes, you can use both. Yes, yeah.
Okay, now that's fair enough. So how do you monitor all these funds? There's a lot of funds out there. There's, I don't know how many there is, but there's a lot. How do you keep a monitor on all the different funds?
So we've invested a lot of resources in making sure that we keep on top of all the managed funds. So we have access to Lonsec, we use Bloomberg, we use Morningstar and FactSet, among other risk systems that we use within our business. We also meet monthly to discuss managed funds and if there's any changes within the fund managers, if there's been people leaving a fund or performance of a fund. So there's a lot of DD that we do on a monthly basis and on a day-to-day basis. Our investment committee, we've been around for the past 24 years. So we've got a large network and we are very close to our fund managers. So if there's any issues, they're pretty much on the front foot and we know them very well. We've been investing with a few of them for the past 20 years. So there's a lot of touch with our fund managers, and it's a small network.
Yeah.
We all know each other. So I think we can actively monitor all the investments that we're invested in, and also peer products that we're looking to invest in over time.
Yeah. Carlo, where do you see AI? Is that going to help artificial intelligence? Is that going to help, over the years to come and monitoring funds, pick out trends? What's your view on that?
I think so. There is some merit in AI being able to help that data collection, but there is still the person at the end of the day that needs to determine what is important. Because one of the issues that we have at the moment is that there's just too much information. We could be reading 200 emails a day, and there'd still be 200 to go. So AI can help in making sure that you get a lot of information and distill it, but it's actually finding out what to do with that information, which relies on human intuition and our business, with the investment committee in determining where we want to invest going forward.
Carlo, you've been doing this for a long time. What's the major changes that have occurred or happened over the last 17 years?
There's a few. I think the access to information is one. So I remember during the GFC, there were hedge funds that we couldn't understand how they performed. And if we don't understand how a fund invests, then we just simply won't invest. Nowadays, you have a fire hydrant of information on a day-to-day basis. So it's now trying to understand what is noise and what's information. So that information piece has changed over the years. The focus on fees is another. So over time, fees have all reduced. It's become a more and more important factor for a few investors. It is important to some extent, but it's not the be-all and end-all. So, in some areas, I don't mind paying a fee. Credit is a very good example of where you want an active manager, and you don't want to pay an index for that. You'd rather have a large fund with a large diversified portfolio of loans rather than a small fund or a index fund that can't make its own covenants. So there's a few. Fees is one, the access to information, just I guess the network overall. There's a lot of people working in finance. It seems to be a lot more information than what it was in the past. Very, very fast news flow.
Yeah. No, I'd agree with that. Well, Carlo, thank you very much for your time. It's really great hearing from you today, and thank you for watching. If you do have any questions about our process, about managed funds or the way we invest, please do give us a call, and we'll love to have a chat with you. See you then. Bye.